welcome to another edition of Wealthy and Wise. I'm your host, Court Christie, and today we're going to be talking about passive income. And in life, most of the time, being passive is not really an attribute that many people look towards. But when it comes to real estate, passive can be really significant and really beneficial to you. But there's some important things you need to understand about passive and active income and how it relates to real estate. And today I brought in a very special guest. We have David Van Landingham, who's one of our consultants and amazing advisors at NCH. And David has a wealth of experience. Besides being a very successful real estate investor himself, he has helped thousands and thousands of real estate investors protect their wealth and help them really with taxes and differentiating passive and active. So we'll jump right into it. David, welcome to the program today.
Glad to be here.
Thank you for being here. I appreciate that. So when we talk about passive and active, what the heck does this mean? What is that?
So it's really more of how the IRS views income that's generated. So active income is generated from working, having a job, doing something daily to earn that money, versus passive income is just exactly what it sounds. It's passive, right? You make an investment and over time it keeps paying you. The difference is how it's taxed. And that's an important thing to understand, simply because sometimes people do the wrong activity in the wrong structure and are paying more than they should. And we all want to pay our taxes, but not more than we should. So when it comes to corporate structuring, there's certainly different philosophies that we use based on structuring. Not everybody's structured the same, but mostly for people that are in real estate investing. If they are flipping properties or doing wholesales, which is a short-term activity, we use a timeline, a one-year timeline. So if the activity takes less than 12 months, it's more than likely active income. 12 months and a day out, it's passive income. So an example of that is if I was to go out, set up an LLC, I would have it taxed as an S corporation if I'm doing short-term. So if I'm doing wholesaling, flipping, like I said, then we're going to have it taxed as an S corporation because there's a lot of benefits that you receive from that. Also, active income is subjected to self-employment tax, right? So there's things we have to understand about that as well. Passive is totally opposite of that, right? As I said, it's you make an investment one time, buy a rental property, put somebody in place, and they're going to hopefully pay you every month. And that is passive because you're not really doing anything to earn the money other than originally purchasing. And then, of course, there's also tax advantages for that. One being that you don't have to file a tax return, which one less piece of paper. So those are key points on that for sure.
Interesting. Now, as you try to sort this out and explain it to people, what's the number one question that comes up about trying to get clarity on, okay, what is passive and what is active and how do these relate?
Perfect. So most of what everybody is concerned about is saving money. So everybody wants to sometimes try to do both activities in one entity. So there are different entity types. So we talk about corporations, S corps, C corps, and then we have LLCs, which can be a little confusing to people because an LLC can actually be taxed 4 different ways. So when we talk to somebody in advisement capacity, when it relates to active income, like I said, we're going to set it up as an LLC taxed as an S corporation. So if I bought a house and I'm going to flip it and put a lot of work into it over a couple months and then sell it inside of 12 months, that's an active activity. So I'm going to be subjected to self-employment income tax, like we mentioned. And by the way we structure, we're able to reduce a portion of that, which puts more money back into their, pockets, if you will. On the passive side of it, generally there's other benefits such as what's called depreciation. So when you buy an asset like a rental property, you're going to have 27 and a half years to recapture all of your money. So if you take the, $200,000 cost of the property, divide that over 27 and a half years, that's going to tell you what your depreciation is for that year. It's usually about 3.63% for each year that you do that. So benefits on both sides, but if you're not structured properly, that's where you run into problems. If you're doing active income as a sole proprietor, you're paying 15.3% on 100% of the money that you make. So that's $15,300. If you had that same LLC or had an LLC set up as an S corporation, now we have the ability to kind of turn the spigot one way between what we earn as a W-2 wage earner and what's called a K-1 distribution. So we actually get paid twice as an LLC taxes and S Corp because we're paid as an employee of the company, which is a reasonable salary. And then we're also paid a ownership distribution, which is the K-1. The K-1 is not subjected to the self-employment tax. So if we had $100,000 run through an LLC taxes and S corporation, that $100,000 is going to be split up. I would say never go less than 30% for your W-2 income. So on that $30,000, you're going to pay 15.3%. The remaining 70% is the K-1 distribution. So in that example, we're saving $10,710 just by being taxed appropriately.
And that's very significant. That's a lot of money to put back in your pocket. Now, David, as a rule of thumb, if somebody's in the real estate business, but it isn't their full-time job, right? What kind of salary do you tell them to draw? Is there a rule of thumb for that?
Here's the problem. You must take a reasonable income, but the IRS doesn't tell you that. There's no guidelines to say what a reasonable income is. They will tell you what's unreasonable in their opinion. So generally, what I tell people to do, if you're in a certain industry, go to salary.com. They do all the research. They know what prevailing wage is for that type of position. The nice thing about this is if you're doing the LLC, taxes and S corporation, and you're going with the 30/70, as I use as an example, there may be reasons that you want to increase that side for the self-employment tax. So I may want to take a bigger W-2 based on things like, I don't know, qualifying for a mortgage. I might need more money.
Or retirement plans that you can max.
Or a retirement plan, right? Because if you're only taking 30,000 out of 100, you've got a very smaller piece of the pie to put into a solo K or a retirement plan. So you can kind of make that grow based on what your needs are. So if you need to take more of a salary, you can take more. We just don't suggest taking less than 30%.
So I know I've heard you talk before about sort of turning what might be considered a non-active sort of flipping business, maybe where you have one or two houses a year. How do you get that into the active world? There's some rules about how much time you have to participate. What is that all about?
So talking about becoming a real estate professional?
Yeah.
Yes. Okay. So there are things out there in the tax code that can help. So based on what your involvement is, if you're not doing this full time, you're kind of a hobbyist at doing it. There are things that you can do to position yourself to receive better advantages from a tax perspective by becoming what's called a real estate professional. Now, when I go out and speak, a lot of times I say, how many real estate professionals do we have in the audience? Everybody raises their hand because they don't know what the definition is. Real estate professional is somebody that spends a minimum, depending upon the type of qualification, whether it's participation, up to 750 hours in that field dedicated towards that. So if you have a couple rental properties, perhaps your property management on those properties yourself, instead of having somebody else do it, those hours can be included in what's called material participation. Now, if you're married, your spouse's hours will count as well.
And that's a way to take something that would normally be passive and turn it into active income. Is that right?
It doesn't as much turn it into active, but it gives you some of the benefits tax-wise from being active.
Okay. Now, I also know that we get questions from our clients about, accumulated losses from their real estate. And, what do you tell them when they've had, let's just say they have a couple rental properties, the depreciation, the taxes, the maintenance, all of that comes in and they've got a loss at the end of the year. And those losses continue the next year, and the next year, and the next year. And they're looking at this ongoing loss. What kind of strategies are out there to address that, being able to utilize that?
Well, that's one of the benefits of being a real estate professional because, without being a real estate professional, you've got a limitation on what you can write off and your losses against gains, which is what you're talking about. So if it's something that you can bring over into the active side just based on being a real estate professional, we can lose that element of having to lock in and say we can only use these losses here against that same company. We can spread those to other companies, such as an active company as well.
Understood. Okay. And so in both of these, scenarios, whether I'm a active flipper of properties, or whether I'm just holding properties long term, you really want to sit down with someone and understand the differences between active and passive, because there's strategies for both of these on how to structure it correctly from the beginning. And clearly what I've heard from you today is you don't put your passive income into the same pot as your active income. You intentionally have two separate LLCs in this case,
Correct.
To work that so you can work the tax code to your benefit.
Exactly.
Is that right?
And that's a part of it. I mean, we are talking about taxes. Now, if we shift real quick to liability, you may not want certain liabilities being in the same entity. So if you're flipping properties, do you have different liabilities there versus, if you're holding something long term? So if you've got active and passive in the same and something happens on a flip, could that affect your rental property? Absolutely, yes. Right. So we're talking about a complete separation for both legal reasons, but also with tax.
Very good. Very important point. Not just about tax. It's about protecting those valuable assets you have as well.
Exactly.
Well, this is fantastic. David, thank you for coming in and giving us a little bit more perspective on passive and active
Absolutely.
income when it comes to real estate investing. And it can also relate to other types of investing, not just real estate as well. And I think it's important for our audience to understand that this is something that you want to have a professional in your corner, want to talk to somebody like David, who, like I said, has talked to and helped support thousands of real estate investors protect their assets and minimize the taxes that they pay. So it's very important to have somebody in your court. That's what we're here for at NCH, to help you do things right from day one. And yes, if you've already done it, we're very happy to help you clean it up as well. So David, thanks for being on today.
Absolutely.
That. And all of you, thank you for tuning into another episode of Wealthy and Wise. I'm your host, Cord Christie. Have a great day.